We published our report on the implications for Asia-Pacific property markets of the UK's referendum vote to leave the European Union, so-called Brexit, on the day after the vote, and repeated our conclusions in a podcast 10 days later. We argued that the Brexit vote had three key implications for core Asia-Pacific investment property markets. Firstly, there would be further downward pressure on already very low global bond yields, and this would highlight the relative attraction of the 3 to 6% yields on core Asia-Pacific investment property markets. Secondly, the vote would remind global investors of the potential for shocks and surprises in developed as well as emerging countries, and so would help mitigate long-standing political and economic concerns about Asia. Thirdly, real interest rates in the region were likely to stay low for longer than we have assumed up to now, to the near-term benefit of Hong Kong and indeed most property markets in the region. 25 days have now passed since the Brexit vote. We would argue that market developments over that time have largely borne out our predictions about the direction of global bond yields and about the outlook for global interest rates. With regard to our second prediction, namely that Brexit will serve to mitigate long-standing political and economic concerns about Asia, it will take longer for the markets to confirm this view. Nevertheless, we stand by our opinion. Today, we would like to draw attention to two other subjects which support our overall stance. Firstly, while bond prices have been rising and yields falling globally and in the US for many years, the world's largest equity market, the US, has also been rallying strongly. In fact, the S&P 500 equity index has recently hit an all-time high after a bull market which began in March 2009 and now constitutes the second longest bull market run in US history. Traditionally, it would have been regarded as unlikely or impossible for the bond market and the equity market to rally strongly at the same time. We see this paradox as evidence of an increasingly desperate international search for yield, that is to say, cash income, in a world of very low or negative interest rates and bond yields. Perhaps the key attraction of property as an asset class is, of course, yield. Now, the yield on property assets should be higher than yields on stocks or bonds, because property assets are much less liquid. Nevertheless, we see the 3 to 6% yields on core Asia-Pacific investment property as attractive and as likely to continue to attract interest. Secondly, as highlighted in a post-Brexit report by Colliers UK and EMEA research team, total funds under management globally by institutions, sovereign wealth funds and private equity amount, by a conservative estimate, to about $36 trillion US. Within that total, allocations to property still stand at below 10%, but have been increasing gradually, and this trend should continue. A 1% increase in total fund allocation to property should translate into a cash inflow of $360 billion, or about 1/3 of global property investment volumes in 2015. With so much capital hunting for yield, it seems perfectly reasonable to expect strong investment interest in commercial property around the world to continue. And this, of course, includes the Asia-Pacific region.